So just to touch on, what is a double tax agreement? In layman's terms, it indicates who has first taxing rights. So I've put the full explanation there. It's a bilateral agreement made between two countries, resolving issues involving double taxation of passive and active income. And remember, this extends to income, capital, estate, and wealth. Right. So let's look at double tax agreements. Remember, this is an annual process that an expat would have to obtain a tax residency certificate in the host country. And you would have to meet the requirements of the DTA to understand who actually gets the first taxing rights. You would also declare your foreign earned income on your tax return in South Africa, but more than likely this will be verified or you will be audited by SARS. If you are successful, what that means is that all your income, your foreign income, will be fully non-taxable in South Africa. But the downside to a DTA is it usually comes at a cost. You have to get a legal tax opinion on this, and the onus of proof is always on the taxpayer to set out these circumstances and the application of the law why you should be exempt from tax. So when would you use a double tax agreement? This is usually for expats who work on a short-term contract and intend to return back to South Africa. There's no formal process in South Africa, so an expat can make a decision at any time to apply for a DTA as long as they feel they meet the respective requirements. Remember, it's a less permanent solution, so there's no reversal of a formal process if you want to go the DTA route. And you have an annual process that you have to convince SARS that you are non-residents. And that means there's a lot of administration around this process. So a tax residency certificate is required by SARS. And remember, this is very time-consuming and also not readily available or possible in some of the African countries, which could be challenging. And it can also become a very costly option. So that's one of the options that expats are considering come 1st of March 2020. Then another option is financial immigration. This is where you formalize your non-tax and exchange control residency in South Africa. It's a formal process through the South African Reserve Bank and through SARS, which is endorsed by Parliament. So what is the golden rule around financial immigration? It is the intention to never return back to South Africa on a permanent basis. Remember, there's no one-size-fits-all here, and everyone's circumstances would need to be analysed, and certain criteria need to be met before you can financially immigrate. What are some of the benefits of financial immigration? You can cash in your pension or Provident Preservation Fund and RAs early without encashment penalties. You can access an inheritance from South Africa only if you have completed a financial immigration process. So if you're living abroad and you haven't formally financially immigrated and someone passes away here, you will have no access to that money unless you have formally financially immigrated. You will also be able to cut your ties from SARS, from foreign income and an asset perspective, as well as your potential future tax on your foreign income. And remember, if you have to weigh up the cost factor, it's relatively inexpensive if you compare it to the 1st of March 2020 changes, as well as applying for DTA. Remember, with a DTA and financial immigration, this triggers a deemed disposal of all your worldwide assets. So there has to be a capital gains tax computation, and that's under Section 9H, and that's what people formally call exit tax. So you need to factor that additional cost in as well. That's just for interest's sake. Right. What is the additional cost to the organisation? So remember, when the individuals are mobilised on a net guaranteed package or equalised, the cost will be borne by the employer. And this will be seen as an extinguishment of debt, which means you're going to have to gross up that additional cost. If the employees were mobilized on a total guaranteed package, you should be computing what is the cost to the employee. How are they going to be impacted? And as I explained before, you need to run those numbers because only then you can make informed decisions. I'm going to show you an example now. We've actually designed a wonderful calculator which you can access on our website to actually show you before and after and what is the cost implication from what the tax legislation shows now and from March 2020. You should look at your policy changes and your employee communication. So you must make sure that these are easy to understand from a policy perspective. You should have clear actions, both from the employee and the employer perspective. You should provide information sessions to your expats and make them aware of these changes that are coming into effect. Remember, your expats are actually very anxious about this. If you haven't started to do this as an employer, you are in a bit of a catch-22 here. It's becoming counterproductive because we get a lot of expats who are incredibly concerned with no direction from the employers. So you need to start to consider this and take this into effect. What I have noticed is you cannot, if expats are on a guaranteed net pay, you can't change their conditions now immediately and say you're going to carry these costs. So organizations would have to also consider grandfathering out certain policies and processes. And once projects have come to an end, they could possibly look at adopting a new approach depending on the cost factor as well. So that is absolutely crucial. And you need to review these changes with the employees. They need to understand this. It's very, very important. Remember, in my experience, when you play with people's net take-home pay, this is the tough area. This is when your employees become aggressive, angry. So it's so important you mitigate and you face this head on. And then for all the payroll professionals in the room, tough times for all of you, hey? And I feel for you. So you guys are going to have to upskill yourselves. You're going to require more training and technical expertise. You're going to have to understand certain elements on the double tax agreements. When you can apply a foreign tax credit on your payroll, and I believe you can do this if the employee still remains on the SA payroll. And that's going to also help minimize that cash impact to the employee. Remember, there is guidance from SARS that you will be able to apply for a tax directive on the payroll, and there should be a dedicated channel from SARS, but whether this is issued timeously, there's a lot of grey areas here, and there will be a lot of challenges. So you need to be aware of this right from the start. And also remember, when calculating your foreign tax credit and your future foreign tax credit, that's going to add to the complexities from a payroll perspective. So you guys, I don't know if you need to start a support group, but it's going to be tough. Right. And that wraps up Expat 102 and some more detail. And I hope it added some value and you learnt a little bit this morning.
Thank you very much, Tanya. So going to go into the question sections, if I recall, one of the questions was, do you find on the client base that companies are less inclined to hire South Africans now based on the added costs, based on the...
Yes, sorry, I must stand up. Yes, most definitely. It's going to make your South African expats less attractive because we've become so much more expensive. So definitely organizations are looking at possibly sourcing expats from other jurisdictions because of the global economy, and that's tough for South Africans as well. It's closing those opportunities for a lot of SA expats.
And then based on the client base, what are they considering? The double tax agreement route, financial immigration route?
So that's an important question. Remember, you cannot apply a blanket approach to your whole population, and that's why this whole process becomes tough. You almost have to look at it at a case-by-case basis. So you cannot just say an organisation is applying DTA right across the board, and that's what's adding to the complexities, both from an employer perspective, from a costing, as well as how is it impacting the expats. So I wish there was a clear-cut answer, but that's the reality.
Okay. And then if you apply for financial immigration and return in 10 years' time, what will the implications be then?
Okay, I'm not a financial immigration expert, but I do have some of my colleagues here. So remember, it's a formal process that your intention is never to return back into South Africa. But if you decide, okay, you've gone and it's another formal process to actually come back into South Africa, to go through the South African Reserve Bank again, to get that status reversed and that formal process. But it is possible. It's just from a compliance aspect from SARS and SARB that you would have to go through.
Okay. And then whether the calculator is made available online?
Yes,
It's still on the
the
website.
calculator is available on any of our websites and anyone can access it.
So just one final question from my side is that, so we've spoken about the remuneration that or compensation that you will receive from the organization, but many expats also earn additional income through rental agreements, through dividends that are paid to them. Does this cater to that? Does the organization have a responsibility to advise them also in their personal capacity for additional income that is earned?
That's a good question. But remember, for Section 10102, it's specifically for foreign services, the remuneration you earn for foreign services abroad. So from an employer's perspective, their liability caters only from the employment earned income. That additional income, like rental and interest and all the rest, that still remains the prerogative and the liability raised there is for the expats account. But I think that adds to the complexity, and it's how you isolate that and do those calculations and differentiate who's responsible for what.
So and I think then a follow-up question, so you have the R1 million exemption. Do you apply that to your earnings as an employee first or to your personal earnings first?
No, it's for foreign services and income earned abroad.
Perfect.
Good.
Thank you very much. There's one more question.
No.
Oh, event feedback. So Tanya, I'll talk about that. Thank you very, very much. We appreciate it as usual. Thank you so much.
Thank you.